Quite a few of us panicked and got out of the market in March and April, and then just never had the nerve to get back in. Some of us just never joined the joyride in the equity market, and now we want to kick ourselves because the market's run up some 40%. You want a piece of the equity market, but you don't know how. Hybrid mutual funds might be the right option for you. So if you can identify with any of these statements that I made, stick with me for the next 4 videos. It's only going to take about 30 minutes of your time in the entire October. And I promise you by the end of it, you'll know where to invest and how to go about it. So with that, let's start with this first video. In this video, I'm just going to tell you what are the different kinds of hybrid mutual funds as defined by SEBI. Secondly, we'll take up the concept of who is an aggressive investor, a moderate investor, and a conservative investor. I want you to identify yourselves with one of these 3 categories and then follow the trail thereon. And lastly, I'm going to cover the concept of arbitrage. Now, it's important for you to understand what arbitrage is, what is the risk associated with arbitrage, because this is a concept we are going to be using very often in the next 3 videos. Now, let's get on to what are the different categories of hybrid mutual funds. I'm going to refer to a sheet here because I don't want to make mistakes. There are quite a few numbers involved, and I'm going to pull up a chart for you. The first category is conservative hybrid mutual funds. Here SEBI says that the equity and equity related components should be in the region of 10 to 25%. Debt instruments are to be in the region of 75 to 90%. Balanced hybrid mutual funds, 40 to 60% in equity and equity related components. No arbitrage is allowed here. Debt instruments are to be in the range of 40 to 60%. Third is your aggressive hybrid mutual funds, where equity and equity related components are to be in the region of 65 to 80%. Debt instruments are to be in the region of 35 to 20%. There is a fourth category of funds called dynamic asset allocation funds. We also call them balanced advantage funds. SEBI does not define the minimum and the maximum limit of equity or debt here. It leaves it to the discretion of the fund manager. Equity savings fund, SEBI says the minimum in equity and equity related options in these funds should be 65%. The minimum in debt in this category should be 10%. There is another category of funds called multi-asset allocation funds. As the name defines, it has to have more than 2 asset classes. It has to have multi-assets, asset classes. So some pick up gold, some pick up real estate, some pick up a combination of real estate, international equities. The underlying being that you have to have more than 2 asset classes or at least 3 asset classes in multi-asset allocation funds. That in each multi-asset allocation fund, you are supposed to have an asset class which constitutes at least 10%. So if I have 3 asset classes, each one should have at least 10%. Then there is a sixth category called the arbitrage fund. Now, arbitrage fund, SEBI says, is supposed to have mostly an arbitrage strategy, and the minimum in equity and equity related instruments in an arbitrage fund has to be 65%. Now with that, let's get on to defining who is an aggressive investor, who is a moderate investor, and who is a conservative investor. I'm going to define a conservative investor as somebody who can take down a drawdown of about 25 to 30%. A moderate investor, somebody who can take down a drawdown of 55 to 60%. An aggressive investor, somebody who can take a drawdown of 75% and above. Now, don't get worried. So when I say drawdown, a drawdown is generally from the peak, okay, not necessarily from where you invested. And secondly, if that drawdown happens, chances are that you're going to bounce back just as quickly. Like you did in March and April. It's not like after 2 years you're still going to be staying at a negative of 75%. Now to the third part of this video. What is arbitrage? I'm going to try and give you an example that is relatable to you in your everyday life. Okay, at least for the women. Think of some really nice pieces of jewelry that you picked up at Janpat at, let's say, 100, 200 bucks, right? And on your way back, you stopped at Santushti. And there, the same line was for about 2,000 bucks. And under some bohemian line, and you're wondering what happened. And you think this is a good option to make profit. So you buy at Janpat, you sell at Santushti. What did you just do? You made a profit because there was an arbitrage window available. So that's as easy as arbitrage is. Now let's relate this to the stock market. Okay, let's say in the spot market, ITC is going at about 300. Okay, I'm not checked the price. I'm just picking up any price. And let's say in the future market, it's at about 315. What do? You buy in the spot market, you sell in the future market, and you make yourself a tidy profit of 15 rupees. And there is next to zero risk involved in this. Now don't get confused with what a spot and a future market is. Spot is your Janpat, future is your Santushti. Okay, so this is how easy arbitrage as a concept is, right? And we'll be using this in the next few videos. Now to end this video, what I'm going to do is I'm going to tell you what I'm going to cover in the second, third and fourth video. In the second video, we'll cover a conservative investor. In the third video, we'll cover a moderate investor. In the fourth video, we'll cover an aggressive investor. Here, we will also cover multi-asset allocation funds, and we will also tell you how to assimilate all the information that you've got in the first three videos, sorry, and how to use that information to make your decisions. So with that, I'm going to say good night to you here while I make the second, third and fourth videos. Have a nice evening. Bye.